What's up guys, my name is Kevin Murray and today I'll be talking about one of the biggest lessons I'm learning right now in the stock market in 2021 is being a overall well-rounded investor. And with my 2.5-3 years of investing, I kind of label myself as a growth investor. It's a strategy that's kind of fits my style as an investor because of how young I am and my risk tolerance and understanding these companies on a high level and seeing their valuations and just running projections on them for the future. It might seem like a lot of work, but it is if you want to make money in the long run or taking investing seriously at a young age. To be a really good investor for the long term, you should understand different types of investing styles. I thought growth investing was the way to go my age to make money in the short term and long term, buying, holding, investing into high flying stocks. But that's not really the case. There's going to be cycles and rotations in the market. In some periods of times, growth stocks are not going to be the home run hitters. They might be going down for a period of time and people are just rotating their money in the short term to travel plays or recovery plays or basic materials. And I'm not really into those short term trends or rotations. But to be a well-rounded investor for my case is to have dividend stocks, growth stocks, value stocks. Growth stocks are usually not profitable yet. They have high growth numbers for the next 5 to 10 years, growing between 15 and 20%. Value plays are like what Warren Buffett does. Companies that are growing have lower valuation multiples, like their PE ratio, and aren't that volatile. They have a margin of safety and all that stuff. Or even dividend stocks too. Companies that are very well established or blue chip companies could be considered value, but also could be considered dividend plays. I'm trying to make my portfolio not as growth intensive, but with my age I should kind of experience the volatility and just experience the day-to-day fluctuations, train my mind and just train my gut to not react emotionally and thinking rationally and thinking on a high level that these companies the next 5 to 10 years are going to make me money and are undervalued. And when I say that I'm a growth investor, I'm not saying I invest in every ARK investment in my portfolio, and the only investment I have from ARK's ETF is Teladoc, which is a very popular retail stock and ARK's number 2 investment. My other positions in my portfolio are investments I made independently, not being biased on any YouTuber or TikToker. I made my own decisions and did my due diligence in my own research, going through the process of reading financial statements and conference calls and investor presentations. With investing, you shouldn't just research the companies you own in your portfolio, and you should have a backlog of different companies in different sectors. I have a big watch list of different companies in different sectors, like the fintech or travel plays, semiconductors, tech, blue chip, dividend stock. I have on my watch list, and each week or so I pick 1 or 2 companies and just spend hours and maybe even days researching that company and seeing if I have a bullish thesis on it. If not, it's going to be on my backlog, and if that stock goes down in the short term a lot, I already am one step ahead from most people and know where this company is going in the next couple of years, and if their valuations make sense in the short term, I might invest into it. With an investor, not every company is going to be a deal in the short term, but maybe in the long term it will. As a great investor, I should know pretty much for myself hundreds of companies ticker symbols, their basic business model, if they're a product or services they're selling, or Yahoo Finance or TD, what I use, and see if their valuations make sense, their PE, price to sales, price to free cash flow ratio, and seeing if this metric makes sense to me. But as I'm making an investment in the market, I'm not just basing it on their metric. I'm basing on other fundamentals. Are they the number 1, 2 player in their industry? How is their management team? Do they have growing revenues? Are they growing in a sector that's going to be exponentially growing the next 5 to 10 years, 15 years down the line? I'm not investing into something that has short-term trends or hype or getting FOMO'd. I'm investing into something for the long term. I'm emphasizing this in this video. Buy and hold, and that's it. That's the game. It's the most boring game out there, but that's how you make money compounded over time. And it's really just summing up this video. You should just know different types of stocks and just have diversification in your portfolio. For myself, I have a majority of growth stocks. I have one dividend stock. I'm looking into more value plays in my portfolio to just diversify my risk, because when growth stocks get hit, they get hit hard. Growth stocks are very volatile. They could go up a lot in the short term, they could go down a lot in the short term. But over time, their companies are going to be game changing in their specific industry. If you know what you're investing in and their valuations make sense in the short term, why not invest into it? They might be priced in for the next 1 to 2 years, but 3, 4, or 5 years down the line, they might be pennies of the dollar, like a steal. And just really continuously doing research on different companies you don't own in your portfolio, just having that backlog and understand different companies and different people that are bullish on or not bullish on. That's how investors are created, who get better, and just kind of self-educate them each and every single day. They don't stop learning. They keep learning about different products or services or companies in the stock market to become better in the market. Thank you for watching, and peace out.